Hello and welcome to the Beginner's Guide to Accountancy. In this first chapter, we will go over a basic introduction to accountancy to give you a taster of what is to come and to hopefully capture your interest within this exciting industry. In future chapters, we will look into more depth on the subjects we have covered within this chapter, but also give you more ideas and concepts to broaden your knowledge. Firstly, we will take a brief look at the following. What are the range of financial transactions that a business uses? Financial documents that are produced from the financial transactions. The first recording of these documents into what we call are the formal books of prime entry. The setup of the formal accounting system into ledgers or the double entry bookkeeping system. Summing up the accounts into helpful statements, and finally, how we gather data from the accountancy system and provide information about the business. Welcome to financial transactions. All businesses require transactions in order to run. All transactions generate documentation, and all of this documentation needs to be inputted into an accountancy system. These transactions can come from a variety of sources. They can come from sales, for example, selling your product to customers. Payment can come from a variety of forms, including cash, on credit, which means payment at a later date, and online payments, to name a few. They can also be purchases. This will be the purchasing of raw materials to make into a saleable product or purchasing goods for resale. Again, a variety of payment methods can be used. Expenses. Similar to purchases, expenses can pay for rent on property, insurance, payment of any energy bills, etc., etc. Expenses can also be for entertainment, vehicle fuel and other items that are not for resale. Finally, we're on to bank account transactions. This covers online payments, credit, debit cards, the CHAP system, transfers, etc. All these can be used to pay for the purchases, expenses or sales that have been mentioned earlier. These are some of the transactions that can take place in order to produce documentation in order for a business to run. Financial documents. Most transactions generate documentation. This documentation will be recorded in a structure called the books of prime entry, which in turn will help run the business and keep everything organized. From the books of prime entry, the information will be entered into a recognized accountancy system in order to produce helpful and beneficial information for the business. Examples of this documentation include receipts from purchasing product from over the counter, i.e. buying your groceries from a supermarket. Purchase invoices when procuring items on credit. Sales invoices, generated from the selling of products to customers on credit. Remittance advice slips, a document that states that a certain amount of money is being sent by a credit customer to a supplier in settlement of an account. Statement of account, sent by the supplier to the buyer at the end of the month, showing what monies are due, including payments received, credit notes refunded, etc. Also with bank details for making payments. Credit notes. This is a refund document and reduces the amount owed by the buyer. Delivery note. When goods are dispatched to the buyer, this document is normally sent with the goods. Finally, another form of documentation is the quotation. This is an initial inquiry into the potential purchase of some products. These are some of the documents produced from various transactions. Next, we will move on to entering these documents into the books of prime entry. The books of prime entry. All of the information gathered from the financial documents will now be entered into the books of prime entry. This will be the first place that the information is entered. This will help to organize everything. The books of prime entry are split into various daybooks, including the daybooks themselves, the cash book, the petty cash book, and the journal. The daybooks contain the information on sales, purchases, sales returns, purchase returns, discounts allowed, and discounts received, plus others. One set of these daybooks is the sales daybook, to keep track of all the sales that the business has made. The sales returns daybook contains information regarding all sold products that have been returned to the business, i.e. due to the products being faulty, etc. And finally, there is the discounts allowed daybook to record any credit notes received. Sales daybooks deal with the transactions with customers. Another set of daybooks are the purchase daybook to record all the products you have purchased, the purchase returns daybook for any products that the business has to send back, and the discounts received daybook to record any discounts that the business has been offered. Purchase daybooks deal with the transactions with suppliers. The cash book records all of the monetary transactions of the business into and out of the business's bank account. Petty cash. Within this daybook is recorded all of the low-value purchases or expenses. Within the journal is recorded all of the other documented information that has no place within any other daybooks. The purpose of the books of prime entry is to have all of the details from the financial documentation entered into a more helpful, organized and readable format. Daybooks also make extensive use of a coding system. This can make following up with queries and looking for corresponding information much easier to manage. Inputting all of this documentation into daybooks saves time and can make the next step easier, which is transferring the information into ledgers. As mentioned earlier, the information from within the books of prime entry will be recorded into ledgers. Most businesses use the double entry bookkeeping system as their chosen accountancy method. The transactions are recorded as debits or credits. We will cover this in more depth next chapter. Bookkeeping accountancy systems can either be manual or computerized. The sales ledger. The sales ledger is classed as a subsidiary ledger in that not every business that uses the double entry bookkeeping system uses it. The sales ledger contains an account for every customer that a business has. Within each customer ledger account is a list of all sales to them, all discounts allowed, and all sales returns values. So it is easy to keep track of what they owe to the business. The sales ledger records all credit transactions, meaning the customer has to pay for the goods within a certain amount of time, usually 30 days. Credit customers can also be known as trade receivables or accounts receivables. The purchase ledger. Like the sales ledger, the purchase ledger contains a list of every supplier the business purchases from. Again, these will be credit suppliers, so the business can receive the product and pay out at a later date. Again, usually 30 days. Under each supplier account is kept the details of the purchases the business makes, any purchase returns, and any discounts received. Credit suppliers are also called trade payables or accounts payables. The purchase ledger is also classed as a subsidiary account, although when using it, it enables the business to know how much it owes to its suppliers at any time. Here are some examples of subsidiary ledgers. both the sales ledger and the purchase ledger. The sales ledger. Within this ledger, you can see 3 customer accounts, customer A, B and C. Also, some of the customers have bought product, sales from the business, sent some of the products back, sales returns, and had a discount, discounts allowed. Next comes the purchase ledger. Here again are 3 suppliers, with examples of purchases, the business buying supplies, sending stuff back, purchase returns, and also discounts received. Finally, a screen of a customer record from a computerized accountancy software program. The general, main or nominal ledger contains all of the other transactions that are not covered within the subsidiary ledgers. The general ledger is split into the following groups. Assets. Assets represent what the business owns, for example, property, vehicles, computer systems, and money that the customers owe the business. Liabilities. This is everything that the business owes to others, i.e. bank loans, if the business has an overdraft, and also what money the business owes to its suppliers. Capital. This represents monies that have been invested into the business by its owners, also called equity. Expenses. Monies coming out of the bank to pay for rent, wages, insurance, etc., also petty cash. Income. This is money coming into the business via the selling of products or services, and also from other takings. So, they are the kinds of accounts within the nominal ledger. Next, we will look at some examples. This is an example of a double entry sales income account. Notice that the transactions are under the credit side. This means that the products are leaving the business and are on their way to the customer. The next 2 examples are of asset accounts, meaning that the business owns these. The asset transactions are on the debit side, showing them coming into the business. The banker loan account represents a liability, as we have to pay the money back to the bank. It is under the credit side to indicate that the money is leaving the business. Capital is, as mentioned, the initial investment made by the owners of the business. The transactions are under the credit side to show monies coming from the owners into the business's bank account. A capital investment is usually the first double entry bookkeeping entry inputted into the ledger. Expense. Here an employee has wined and dined a client and put the cost through as an expense. It is a debit because the money has come from the bank account and into the entertainment expense account, so the business can pinpoint where money has been spent. Next, on to control accounts. Control accounts are the total accounts within the general ledger. They represent the total of the subsidiary accounts so that businesses can see at a glance how much is owed to them from customers and how much is owed by them to the suppliers. The sales ledger control account. This account contains the total figures from all of the individual customer accounts and tells the business what is owed to them. Also, by keeping a sales ledger, the business can find out what is owed by individual customers. The purchase ledger control account. This is the opposite to the sales ledger control account and holds the total monies owed to suppliers. Again, by keeping a purchase ledger, the business can look up monies owed to each individual supplier. Having these total control accounts can be very useful and are used effectively by business management. As you can see from this example, The arrows represent the totals going from the subsidiary sales ledger to the sales ledger control account, and from the subsidiary purchase ledger to the purchase ledger control account. Next, we shall look at the trial balance, this being an important statement within accounting that managers can make use of. This trial balance contains the following: the title of the business, the date of the period the trial balance is for. Customers owe you £9,000 due to product being sold to them on credit. You owe your suppliers £6,000 from goods purchased on credit. Your business owns £5,000 worth of raw materials. You owe £7,000 to the bank because of a bank loan that was taken out. You have paid this month's rates and wages to the tune of £500 and £1,200 respectively. You invested £2,700 into the business to start it up. Due to the interaction of debits and credits, the total of both columns should be the same, which they are. Congratulations. We will now learn a very important equation. This is called the accounting equation, and it is assets, what the business owns, minus liabilities, what the business owes, equals capital or equity, which is the investment into the business. So, assets minus liabilities equals capital. Please remember this. Next, another important statement, the statement of financial position. The statement of financial position. This statement makes a good use of the accounting equation to show a snapshot of the business at any particular time. Within this statement is the name of the company, the title of the statement, and the date the statement is for. Next are the listings of the assets. Here they are: cash of £18,000 and customers owe us £8,000. This gives the total assets of £26,000. Now on to listing liabilities. They are: we owe suppliers £15,500, so the total liabilities will be £15,500. Next, on to owner's equity or capital, which is £10,500, meaning the total owner's equity equals £10,500. Lastly, the total of the liabilities and the owner's equity has been entered. Notice that this total will equal the total assets. Remember, assets minus liabilities equals capital. The profit and loss statement. This is another important statement that shows whether the business has made a profit or a loss. Profit is the one we're aiming for. As with the other statements, this one starts off with the name of the business, the name of the statement, and the date of the statement. The first section covers all of the income that has come into the business from all sources. After the income comes all of the expenses the business has made. Lastly is an important equation that calculates the profit or loss. This is income minus expenses equals profit. Luckily, this business has made a healthy profit. So that's it for the first chapter. I hope this has piqued your interest within the field of accountancy. Here is a summary of what we have learnt. The accountancy equation. Remember, assets minus liabilities equals capital. We took a look at what transactions a business can use. Next was the financial documents produced from those transactions. Thirdly, we had a quick look at the books of prime entry, including the daybooks, cash book, petty cash book, and the journal. The subsidiary ledgers, the sales ledger, and the purchase ledger. The main, nominal, or general ledger. The control accounts that total up the subsidiary ledgers of customers and suppliers. Putting together all of the information to produce a trial balance. The statement of financial position. And lastly, the profit and loss statement. Next, we will take an in-depth look at the double entry system.